Hello everyone. I want to talk about minimizing taxes, okay? In Canada, legally, okay? Now, this is a video that I've been actually doing a lot of research to develop, but there isn't a lot of information out there. Now, there's a lot of information how to minimize taxes by obviously using your RSP, dumping a lot of money in your RSP, and then lowering your tax bracket. But what are some of the other strategies? And this is what I really want to talk about today is how to use the tax loss harvesting method in Canada to minimize your taxes and almost pay $0 in taxes. So if you are wondering how to minimize your taxes in, well, the last part of the year before year end, because you got some capital gains that you want to offset and not just talk about, hey, using your RSPs to lower your taxes, then you definitely want to check out today's video. So in today's video, I want to talk about everything to do with tax loss harvesting, about the drawbacks of it, how to even do it, what way you can't do it with, like what accounts you can't do tax loss harvesting with. And lastly, I also want to talk about how you can use tax loss harvesting in the future in your accounts. What is the best way to do this? So how does tax loss harvesting work? So tax loss harvesting is a lesser known strategy as a way to offset capital gains. And it only applies to non-registered accounts. The way it works is, say you sold a property, okay, and you had a capital gain of $100,000, meaning after paying all the expenses, paying your lawyer, paying the realtor, you made $100,000 of capital gains in profit from this selling this property. But then you're like, I really want to find a way to minimize your taxes. Now, of course, you could dump a lot of money into your RSPs, assuming you have contribution room to lower your tax bracket. But then there's another method, and that is tax loss harvesting. So simply how it works is you find ways to, well, sell things at a loss, and then that loss could offset a capital gain. So for example, getting back to that property, if you had $100,000 in capital gains, and then you unfortunately bought some Bitcoin, bought some crypto investments, which are in non-registered accounts, and they had a $100,000 loss, well, you can effectively sell those and then put it in a wash. So basically you will pay $0 in taxes for this year. So again, you have $100,000 in capital gains from your property, but then you also have $100,000 in capital losses in crypto. So then all that washes out in the end and you pay $0 to taxes to the CRA. Before you jump in the bandwagon and start selling your crypto to offset capital gains this year, I want to talk about this massive implication, and that is the superficial loss, okay? Now, how the superficial loss rule works is that if, for example, you did have a lot of losses in some crypto, like your Bitcoin, your Ethereum, etc., and you sold it, and then all of a sudden you think, hey, I want to buy back in. Well, you can't buy back in less than 30 days. So for example, if you sold your crypto losses at, say, December 25th, the next time you can even consider buying it back would be after January 26th, okay? To give it a full 30 days, because the moment you decide to sell your crypto and they're like, hey, I changed my mind, I'm going to buy it back the next day, well, that doesn't help, okay? You're not going to be able to harvest any tax losses because you bought the asset right away within 30 days. And don't think that you could just like get around this loophole and get your spouse or your partner to actually buy back crypto in a different account, or think you could go to your corporation now because it's like a separate entity and get the corporation to buy the assets, the crypto back in, okay, within those 30 days. It ain't gonna work. So don't even think about it. So the implications are, please, you sell things at a loss, don't buy back within 30 days. Also, don't find another way to buy back those assets in a corporation or through your spouse or through your children. It ain't gonna work because CRA is gonna catch you. But of course, I am not an accountant. I am just some YouTuber who's just giving my thoughts and opinions about this tax loss harvesting method. So please, if you use any of these strategies, please consult with a real life tax accountant, okay? Because I am not it. Oh, I forgot to mention, there is also one big rule. You definitely want to harvest these tax losses before the year end, and the year end date is December 28th, 2022. Again, this is December 28th, 2022. So you got to close your positions and sell at a loss to offset capital gains by December 28th, 2022. So if you are considering using the tax loss harvesting method, the only accounts that applies to is non-registered accounts. So that means if you have a TFSA, you have a RRSP, you have a RESP, you have a LIRA, and you have some speculative investments or some investments that are at a loss and you're hoping to sell them to actually harvest this tax loss, well, unfortunately, it doesn't count because those are registered accounts and they're built that way so that, well, you don't pay any taxes at all when you make money in those accounts. But then if they are at a loss, you also can't harvest those losses. So this tax loss harvesting method only works for non-registered accounts. So you have non-registered accounts in your corporation, you have non-registered accounts personally, but basically it only applies to non-registered accounts. So what are the biggest drawbacks of tax loss selling? Well, biggest drawback is obviously you are going to show a loss. Okay, so if you are looking to sell your asset just to offset capital gains and just hope to do that, it might not be the best method for you. You got to really consider this. Talk to your tax accountant. If you're looking to sell these assets at a loss, but then plan to rebuy back after 30 days because the losses are going to be about the same and this is just a way for you to offset capital gains, that might be a better strategy to use. But again, talk to your accountant. Now, the biggest drawback of the tax loss harvesting is obviously you're selling an asset, and if it goes up in the future, then obviously you're going to not get any of those capital gains. You're going to lose out on those potential capital gains in the future. So you got to be very careful and really think, do you really want to sell at a loss just to offset capital gains for that year? And again, like I said, please talk to your accountant about this. Now, I want to talk about how to put yourself in the best position to use this tax loss harvesting method, okay? Say, for example, you don't have any capital gains to offset this year, but you're like planning to think about, okay, maybe in the future you're going to have capital gains, and maybe you're like how to minimize taxes in the future. So I'm going to talk about this strategy about how to put yourself in the best position to do this. So if you have investments that are more speculative, maybe they're growth investments, maybe they're crypto investments, maybe they're just plain out very speculative investments, you always want to put them in non-registered accounts. The reason being that you want to put them in non-registered accounts is so simply you can use this strategy. So for example, if you decide to do private money investing, maybe you're lending money out to someone, some person to finance a property, and so you're basically a bank, okay, to the other person. That would be considered a more speculative investment. You definitely want to do this in a non-registered account, just in case that blows up. If it does blow up, then you can harvest those losses and carry it forward for many different years. In fact, indefinitely, but you got to do this in a non-registered account. Another thing is that if you do have tax losses in a non-registered account, you could always carry back up to 3 years into the past. So you might have had capital gains, say maybe 2 years ago. Well, you can possibly offset those capital gains up to 3 years. But again, please talk to your accountant about how to use this strategy, how to work out the mechanics and get that to CRA, because I actually don't know how that works. I just know you can carry back the losses up to 3 years, and you can carry forward the losses indefinitely until you actually have to use them. Anyways, I hope you found this video super helpful. It took me a long time to figure this whole thing out because I had to talk to my accountant. I had to look at my own situation because I had capital gains this year, and I thought, hey, instead of me figuring this all out, let me do a video for you. Now, if you want more of these type of videos, check out this playlist up here on stock investing in Canada. If you want to talk about real estate investing, check out this playlist up here. I'll see you hopefully in the next video. Bye.